All right, now for the long-awaited, drum roll please, QBI. This is a exceedingly complex piece of legislation. It's, I don't know, probably 200 pages of the tax law when you look at all these different things that go along the way. And we still don't have all the definitions, and I'll point those out as we get into this. So we will be evolving along the way. A lot of it's going to be decided in court, because when you talk about definitions of the SSTB, which I'll get into definition of that, when you get into the specific definition of that, there's going to be a lot of subtleties, whether you're qualified or not qualified in that provision. So we'll have to talk about those things. So the pass-through entities have a new odd path to their taxable income. This is Section 199A. If you recall, we had Section 199 for about 10 years, the domestic production activity deduction. That was a 9% deduction that construction and manufacturing was able to take strictly as a gift. It was that much of your income was not taxed. That was eliminated at the end of 17, and now we have a 20% deduction for most industries. So the construction industry is protected. They're one of those who will get the 20%. So that will be beneficial in that regard. But you will no longer have the 199 DPAD that we had before. Most non-passive income, and this includes rental income, will be considered qualified business income, QBI. And I'll use 199A and QBI, QBID interchangeably throughout this because they're essentially the same thing. So first you determine the taxable income from the pass-through entity and then take 20% of that amount and deduct it. So if you have $100,000 net income, only 80% of it will be taxable. It's not quite that simple because there's a lot of caveats and limitations, but that's fundamentally what you've got. It's not taken off the business K1 that you get from the pass-through. It's taken on the 1040 in a special place. So it's a new line they have. Specified professional service businesses have a phase out of this amount, and we'll get into the details of that. But they deemed that certain professions were not entitled to this, and this includes accountants and lawyers and other professionals, investment managers, different people like that. So that will be important to keep up with along the way for those industries. High-income business QBID is limited based on wages and fixed assets, and we'll talk about the detail of that too. So if you don't have any wages and have a high-income pass-through, you may find yourself clipped there. If you don't have wages but do have a lot of tangible property, then you may be able to get under that. And we'll go into all these details. So what does QBI include? Qualified business income includes the income of a taxpayer, including a trust or estate, but not a C corporation, a sole proprietor, an S corporation, and or partnership that has pass-through income. So that's virtually everything except a C corporation being the one that pays its own taxes, all the big boys out there. From the conduct of a qualified trade or business in the United States, including rental income. Now that was kind of a wild thing that showed up. We said, rental income's never qualified for any of these breaks. Well, suddenly it does. So somebody got to somebody up there and said, let's put this in there, and it got passed through. Qualified real estate investment trusts, REITs, are included, as well as public partnerships and dividends, well, dividends from the REITs and qualified public partnerships. Those are pass-through income. Well, those have always been off the books because they're treated as publicly traded activities. So why would I get a break on those kind of pass-throughs? Well, it's going to be important to keep up with those now. So we'll find some folks moving in those directions because they get the extra 20% reduction. There will be extra provisions on those to show they have the qualifying wages and or equipment, because you're not going to know that because you don't see their financial statements. 199A deduction is a 20% reduction over overall qualified business income. It's that simple, except for all the extraneous baggage that we're going to talk about. It's allowed to itemizers and non-itemizers. It's not a Schedule A item. It's got its own separate line on the 1040. QBID does not apply for purposes of the 3.8% net investment tax. That's the Medicare surtax that we have had on the pass-through income, so you don't get the deduction from that. So you'll still have to pay the extra 3.8 on the investment income, but you don't have to pay the income tax. Most of the time, investment income is excluded from the QBI, so it really will not hurt us too bad. The QBID is available to those taxpayers who itemize and those who, well, I've got that in standard deduction. the net operating loss does not affect the QBID. So you don't have to worry about that reduction in your income affecting your qualified business income. The QBID does not reduce your self-employment tax. So if you've got a Schedule C or a partnership that you pass through and have to pay self-employment tax on that $100,000, you'll get the 20% reduction in the income, but you will not get the reduction in the self-employment tax. You'll still have to pay it on the full 100, not on the 80 after the QBID. QBID is the same for regular tax and AMT, so it doesn't have any impact on that. But as we saw earlier, the threshold for the alternative minimum tax is much higher, so very few people will actually fall into that anyway. Okay, here's where the first caveat gets into play. For all qualified taxpayers whose taxable income does not exceed $315,000 for married filing joint or $157,500 for everybody else, in tax years after 17 and before January 1st, 2026, if you believe Congress will keep their mitts off all this between now and then, an individual may deduct 20%, and I'm not saying this over and over again, but it's complicated and the redundancy helps us, 20% of qualified business income for partnerships, S corporation, and sole proprietorship. All of that pass-through income will qualify if you don't have any other landmines along the way. So basic example, $100,000 of QBI income, you get a $20,000 deduction. It's that simple. All right, example one, Sam owns an S corporation, makes $300,000 before his salary. He has a $100,000 salary, so his net income is $200,000. He gets a 20% deduction off of the $200,000. So you'd say, well, why wouldn't he just leave it at $300,000, not take the salary? Well, that's where the wage test comes in. We'll see that in a minute. If you don't have any wages, then you don't get the benefit. So example two, Samantha is a partner who receives a guaranteed payment from a partnership. Her share of partnership profits are equal to $200,000 and she receives $100,000 of guaranteed payment. That's the equivalent of a salary coming out of a partnership. The QBID would be 20% of the $200,000 or $40,000. So you don't have to worry about the salary deduction there because it's qualified based on the whole K1. So limitation number one, the ratio of income above the threshold amount, which is the rule number one, General Rule Part 1 in the law, applies to any trade or business with a special rule for specified service trade or business, STBs, that restrict other limitations. So if your income is above the 315 to 415 range of the phase out and half of that for individuals, that's the first rule is the income limitation. There's going to be industries that affects and industries that does not affect. So another example based on that, a taxpayer, a single woman, has $150,000 of qualified business income from a sole proprietorship selling t-shirts and pays no wages. With income of $150,000 from that activity and taxable income of $175,000, which is above the $157,500 phase out for a single person, the QBID must be reduced. So how do you get there? $175,000 is her total income, $157,500 is the threshold. You take the difference as $17,500. Then you divide that by $50,000, which is the range between the high and low of the phase out, and determine that 35%, she's got 35% of her income is above that threshold. So 35% is the number that we have to phase out. So the percentage by which the otherwise available QBID must be reduced, in this case, allowable QBID is 65% of $30,000 or $19,500. So we're allowed to take 65% of that amount, and that's the QBID deduction. She's in that window between the phase-out numbers, high and low, and we take the ratio of that $50,000 range, and that's how we determine what the deduction is for somebody in that area. Thank goodness we have software to figure this stuff out. We'd have to double your accounting fee to do this otherwise. That's the only reason we get some of this law, is we now have the ability to calculate stuff with software. Limitation number two, wage limitation. We talked about the fact if you don't have wages in a pass-through entity, then you may not qualify for this. So it applies to any trade or business except an SSTB, so a specialized service trade or business. So the wage limit at or below 157.5 single, 315 joint, you don't have to have the W-2 amount. If you're above those thresholds, that's where the phase out starts. Then you have to see whether you've got W-2 wages or depreciable property. So we'll talk about the wages first. The only limitation in this circumstance is the taxable income limitation, which applies when the taxable income is less than QBID. This is not adjusted gross income, which is the last number on the front page of the tax return, or at least it used to be, because all of the forms are different, and we'll talk about that at the end. You'll not recognize the 1040 or the schedules 1, 2, 3, 4, 5, 6. We haven't had those before, right? Plus the schedule A and B are different. So we're talking about the phase out now when you're at above 157.5 for its individual, 315 for a joint. You don't have to worry about it if you're below that threshold about the wages. If you're above that threshold, you have to have wages. Or you have to have qualified property. And we'll go through some examples on this when we get there. Qualified property is defined as the unadjusted basis immediately after acquisition of tangible personal property held by and available for use in the qualified trade or business at the close of the tax year, used at any point during the tax year in the production of QBI, and if the depreciable period has not ended before the close of the tax year. Somebody want to volunteer what that means? No hands. I don't understand. What that means is if you don't have wages or don't have sufficient wages to qualify as a reasonable salary in order to qualify above the 315 or the 157.5 thresholds, you can take 2.5% of your property on your balance sheet. Okay, now we've got a little caveat here, because remember we talked before you can deduct up to $2,500 of your property. Well, if all you have is desks and chairs and computers, you've expensed all that. You don't have any fixed assets that we can use to calculate this qualified property. So it's what you put on the balance sheet and depreciate is what we qualify, and it's based on the original purchase price. So if you have bought equipment and you still have it on the books and it's still depreciable within the depreciable life, which is where we're talking about this depreciable period is not yet ended. If it's 5-year property, you can use it for 5 years. If it's 10-year property, you can use it 10 years. You take 2.5% of those assets that are still being depreciated to determine whether you have any base to qualify yourself for the QBID. This only affects those above those minimum levels, 157.5 and 315. So is that a little bit clearer? I know it's still muddy, but that's the alternative test if you don't have sufficient wages. The depreciable period means the latter of the date that is 10 years after the property was in service or the last full year of the property's recovery period under Internal Revenue Section 168. So if it's a 5-year property, they're going to give you 10 years if you still have it 10 years. But if it's a 15-year property, then it's only going to stop, it goes to 15. So it's 10 years on everything except those that are longer than 10, and you can go for the longer period in that case. They will still qualify. So that's another calculation we have to do. What is the tangible assets that we have got on the balance sheet? Multiply that times 2.5%. So we may be wanting to clean up your balance sheets a little bit to make sure this is all legit. The W-2 wage limit is integrated with the unadjusted basis of assets. So you can use both of those. If one doesn't get you there, the other one can pick up the gap. QBID, Qualified Business Income Deduction, qualifies when the QBI is over the taxable income limit, 157.5, 315, and is limited to greater of either 50% of the allocable wage share of the W-2 wages, meaning if you own 50% of the business, 25% of the business, that's your share of the wages that you'll get on your K-1. You use 50% of that number as your test, or 25% of the allocable share of wages plus 2.5% of the unadjusted basis of depreciable property. So you'll be able to use 25% wages and 25% of the unadjusted basis of the depreciable property. So why would this matter? Well, let's suppose that you're an independent contractor and you have an S corporation and you're driving a truck and you're getting paid, say net income of $50,000. Well, that wouldn't matter because we're under that, but just for simplicity, let's say $50,000 net income from that business. He's got a truck, he's depreciating it, he's going to have something there, but he may choose not to take a salary. So we can't use the wage limit, so we can now use 25% of the, or 2.5% of that amount, and that can be 25% of the amount that qualifies to give him a little bit of QBID. So there's a big interplay of all these different things. Thank goodness for computers again, that we can do that. But you can get the fundamentals now that you either use all wages, 50% of wages, or you can use 25% on the wage side and 25% on the depreciable property side. If you have no wages, then you're just going to get half because you only have the depreciable property. So a little bit clearer maybe? You can kind of see through the fog? I know it's nonsense, but it is what it is. The unadjustable basis is the depreciation deductions relative to the property not taken into account with respect to 2.5% limitation. Taking a bonus in Section 179 will have no impact on this limitation because you have in fact put that on your balance sheet. It's a depreciable asset, and even though we fully depreciated it either through bonus or 179, you're still getting the full deduction. The full allowance, because you're using the original cost, you're not using the net. Now, one other thing, I don't know that we mentioned this before in going through, but this can come into play right here. In the past, when we've had trade-ins of property, you trade in a truck or heavy equipment or something like that, in the past, we've taken the undepreciated portion of that and rolled it into the next, the like-kind exchange, into the next equipment. So if you had $1,000 left on some asset and it's being traded in for something else, you take the $1,000 and add it to the cash paid of the new item, and that's your new basis. We no longer have trade-ins, no longer like-kind exchanges on the tax basis for your balance sheet. So we'll have to now have a gain or loss on the trade-in versus the cost or the net depreciable basis. So if you got a $5,000 trade-in on a $1,000 net basis after depreciation, you've got a $4,000 gain on the trade-in of that old vehicle, and then you have to take depreciation on the new one in full. In most cases, that's not a problem because you're going to take 179 or bonus on the new item, so you've got a full deduction and a gain, and they net out. So you're going to have about the same answer, but we have to go through that exercise now. I'm not sure what lobby fell down on that one, but anyhow, it's a little caveat we've got to do. But that's an aside from here. It doesn't matter if you take depreciation on an accelerated basis over 5 years or 8 years or whatever it is, or if you're going to depreciate it under 179 as a full deduction, or you're going to take it as the bonus depreciation. We still take the original value of the unadjusted basis before depreciation in calculating these QBID deduction limitations. Now, what is a wage? That was one we had to get some definition because the law didn't specify. And in August, I think it was, they came out with some rules what wages are considered. Because as you know, there's all these boxes and all the different numbers, and you got box 14 and box 12 that have all these limitations and phase outs, all those different things. They came up with a definition of what a wage is. It includes taxable wages and deferred compensation with an add back for employees' elective deferrals. That would be a 401k, for example. So your gross wage is going to be the gross wage before having the deduction for the 401k. Allocable W-2 wages for a shareholder are, like all other items of an S corporation, allocated pro rata based on a per share per day basis. So if you own 25% of an S corporation, you're going to have disclosure to you of 25% of the salary. We had that on the QBID, on the DPAD before. That was shown on the back schedule of the K-1. So we always had that information, but this will also have to be a disclosure that the preparer of the return will have to give to you as the shareholder or partner. Wages paid to an employee include any elective deferrals like a 401k, which I mentioned that, or any other deferred compensation. So gross wages will be gross wages, and that's how we'll deal with that. From a partnership, the wages are also going to be allocated through a partnership, just like they are with the S corporation. You'll get your allocable share based on your ownership. 20% partner may specifically be allocated 80% of any depreciation, and 30% of Schedule K-1 ordinary income under the partnership agreement. A lot of partnership agreements, as opposed to an S corporation, everybody's got to be uniform in terms of their percentage. In a partnership agreement, you can pick and choose income and deduction items in your agreement. So I'm going to take all the rental income and you're going to take all the operating income. I'm going to take all the depreciation, you take all the interest. We can divide those things up in a partnership. You can't do that in an S corporation. So the 20% partner will still be able to take all those pieces and parts. So we have a tax planning opportunity. This works very well with generational partnerships where the elder wants to get certain things and the younger is maybe in a lower tax bracket, so you give them more income and you take more deductions. So the 20% is going to be based on your percentage of ownership in the pass-through of the QBID items, but you will be able to manipulate your income based on your partnership agreement. Because the partnership the partner is allocated 30% of the partnership's line one income, that's the gross income, the partner is only allocated 30% of the W-2 wages. So no matter what you do with all this other stuff, it's what percentage of capital or your profit and loss allocation is going to be, is the amount of wages that would be passed through. Wages allocated from an S corporation, it is what it is, because you are fixed. Everybody's got to be the same or you can lose your S election. So all the distributions, all the allocation of income, interest, deduction, depreciation, all has to be done based on your ownership share. Limitation number 3, specified service trade or business limitation. I've danced around this and now we're going to drive straight through it. It applies only to a trade or business identified in the statute as not qualifying for the general rule, meaning that everybody else gets the goodies of the 20% deduction except those in this category. So the disqualification for SSTB is those that are in these specific industries, if they're above the 315 or the 157.5 income threshold, and this is taxable income, then they have to deal with a second calculation to see whether they are going to be qualified or not. And they are, and it's in your handout if you can't read this. Specified service trade or business means any trade or business involving the performance of a service in the fields of health, doctors, nurses, etc., law, lawyers, paralegals, accounting. Anybody that does tax preparation for a fee is considered an accountant. I don't care if you get $150,000 working a day job. If you make $2,000 on the weekend doing tax preparation, you're stuck with this on this little piece of your income. Actuarial science, performing arts. So now you got all the actors out there, all the singers. They're all going to get clipped on this. Consulting. That's going to be the tricky one. What is a consultant? We're looking for more definitions with that. But consultants generally are anybody that provides advice only. So if you come in and you need, should I buy or sell this property? And you do a calculation, you're a consultant. But if it's a real estate commission, you're not a consultant. That's part of the service that you're doing. Athletes, this is a new one too. If you are incorporated as an athlete, then you're going to get stung on that. Now, usually you're a salaried person, but you can imagine most golfers are independent contractors. Most tennis players are independent contractors. So they're going to get clipped on this because they are a specified service trade or business. Financial services. This one took some extra definition. Anybody that's buying or selling securities, and there's a whole long list. I think there's 9 different specifics of defining what the financial services are. They are going to be limited in this. However, an insurance agent is not. Again, I don't know how the lobbyists work through this, but if you're doing a variable annuity in a life insurance contract, you're selling an insurance contract and you're getting a commission. Not any different than the guy that's over here selling mutual funds, doing the same kind of investing, but he gets clipped on his commission or management fee while the insurance agent does not. And then brokerage services, including investing, investment management, trading, dealing in securities, partnership interests, commodities, or any other trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees. So that covers a broad range of people that are in the security business. And there's one other one in here that I didn't list, but there's any other business that has personal services, the primary source of income. I thought that was going to include people like fortune tellers. Not that anybody made $300,000, maybe you could, but it doesn't. It's anybody that is specifically earning money as a consultant, doing advice, doing things like that. It's not just anybody out there doing a service. You hire somebody to rake your yard, that sort of thing. They will not be included in that. Okay, back to the 157.5.315 limit. For the SSTB businesses, starting at these 2 thresholds, individual and joint, you're going to have to limit your income, limit your qualified business income deduction based on these rules. So the example down here is you have taxpayer, single taxpayer with $157,000 for the accounting practice, and total taxable income is $175,000. So again, we're going to be clipped as we did in the previous example. 157.5. 175 minus 157.5 is 17.5 divided by the 50 phase-out threshold, 35%. So it's the same example as before. So whether you don't have wages in your business, so you don't have pass-through, or whether you're a person with a SSTB source of income, they both get phased out the same way. Same facts, except one in case it's a regular business but had no wages. In this case, they may have wages, but they're in a specialized service trader business. Example 4, Dave is an unmarried individual and has a CPA practice where he earns $100,000 annually. Assuming Dave's taxable income is under $157,500, he is entitled to use the entire amount. Because he's below the $157,500 threshold, he doesn't have to worry about the fact that he's an SSTB. Example 5, Doris is an MD with a QBI of $500,000. She files an income tax return jointly with her spouse. With his losses, their taxable income is only $310,000. There may be some divorce in the future in this one, I don't know, but anyway. Even though Doris has a QBI for medical practice, which is an SSTB, she's entitled to the full 199A deduction because her joint income is not greater than $315,000. So now you see the interplay with all of the other sources of income. You may be over the threshold in your specialized service business, but you may have an offsetting deduction from some other source. It could be a rental loss, it could be a business loss, whatever it may be. So you have to put all that together. So in this case, she would get the full 20% of the taxable income of $310,000. So now we look at the interplay of the phase out in the specified service trader business. When the income of a specified service trader business, SSTB, exceeds the threshold amount and the phase out ratio is 0, it is possible to qualify for the QBID. However, the calculation is more complex than a simple percentage of wages and property. The ratio would limit the QBID and is applied to the potential wage and property amounts to determine the QBI to which the 20% allowable QBID is applied. So if you don't have enough wages, or you don't have enough equipment, or you're over the threshold and you're in that phase-out zone, it can be a very complex calculation, as you can see, because you may not have enough wages to get there, even though you're under the limit for wages. But you may, SSTB, or you have more SSTB and not enough of the other. So you have to look at all the interplay of all these things. Again, thank you for having computers. Limitation number 4. Capital gains. Taxpayer cannot deduct more than 20% of his or her taxable income after subtracting net capital gains, but before deducting the 199A. Capital gain income has to be subtracted to determine how much the limitation is for the 20%. Because remember, you're taking 20% of your taxable income. So let's assume the taxpayer would receive $40,000 in 199A qualified business income. I'm sorry, $40,000 on $200,000, 20% of $200,000 from the pass-through entity. If due to deductions, the taxpayer's taxable income is only $160,000 instead of the $200,000, and that amount includes $60,000 of net capital gain, the taxpayer's QBID is limited 20% of 160 total, less the $60,000 capital. It's only $100,000. So you get 20% of 100. You don't get 20% of 160. So we have to take out the capital gain portion of the income to determine the qualified business income limitation. Example, the taxpayer has $2 million of QBI from the sole proprietorship, has no depreciable property, pays an assistant $100,000, potentially entitled to QBID of $400,000. You see, we keep making these problems more complex because this is reality. Reducing income by 37% of $400,000 or $148,000. However, the individual's taxable income far exceeds the $157,500 threshold, so the QBID is 50% of the $100,000 or 50. So you're going to be limited because the wages are too small, even though there's no restrictions otherwise. So she would get 37% of $50,000 or $18,500. That's the only amount they're going to get. So that's unfortunate, but that's how the rules are. You've got to look at all of the factors. So it might pay to pay more salaries in order to get a bigger deduction. Example 8, taxpayer is an S corporation shareholder, has $1 million of qualified business income and is potentially entitled to a QBID of $200,000, 20% of $1 million. But allocated W-2 wages are $300,000 and the corporation has no depreciable property. So she can only deduct $150,000, which is 50% of the 300 or 150. The potential reducing income by 37% times 150 or 55.5. So because there's not enough wages, there's not going to be the ability to take it all. The wages are 300. You're limited to 50% of wages, so you have to take the 150,000 as the base of the limitation. So that's all we're going to be allowed is 37% of the 150,000. Example 9, the current tax year qualified business has $100,000 of ordinary income from inventory sales and makes an expenditure of $25,000 that is required to be capitalized and amortized over 5 years under applicable tax rules. QBI is $100,000 minus the $5,000, which is 1/5 of the 5 years of $25,000. So that leaves you only $95,000. QBI is reduced only by the amount of deductible in determining the taxable income for the year. So what do we do about all this? You need to be prepared. You need to think it through. You need to look at all the caveats that are going on in a year and maybe plan some things. Well, I don't have enough QBI equipment to make this work. I need to have more salaries. I need to buy a piece of equipment. I need to put something on the books in order to make myself qualify. Or maybe I don't want to do it this year because I'm going to have more income next year and that deduction's worth more to me next year to get me below that phase-out threshold. All these factors play into the game. I read an article yesterday, very interesting. A guy was talking about his retirement planning. He said, well, if I take a deduction to put it into my retirement plan, I'm reducing my taxable income, which is going to reduce the amount of the 20% that I'm reducing my income that I pay tax on. Is it better for me to take a $20% reduction in my higher income, or take the lower QBID calculation against a lower income after taking the retirement plan? Obviously, there's some algebra involved in that calculation, but it may be worth thinking about. Is it better to have more taxable income and get a higher business QBID deduction, or take the business deduction for the retirement contribution and pay a lower tax because of that, thereby limiting the QBID deduction? So I know that's a whole lot in a short period of time, but what questions do you have about this? Everybody has a glazed eye in their face, right? What about anything else that we might have covered that you may have questions about? There's a lot of things that are the same. Capital gain rates are still 15%, 20%, or below a certain threshold, 0. So capital gain hasn't changed. There's still a $3,000 limitation on capital losses. Itemized deductions are a train wreck, so they're all going to be different. The actual Schedule A is shorter. So I've either totally covered it or totally confused you. I'm not sure which. You think? You think you need a CPA? That's a good news. You're going to push us over that 315 limit and have to pay taxes. One thing I learned a long time ago in tax planning, I don't care how much your income is, it's never 100% tax. So it may be worth earning an extra dollar. Now, if you live in a state that has income tax, it's really going to be a mess, because most of the states are not adopting this deduction. Most of the states have not adopted bonus depreciation. So you've got to look at the interplay between the income tax in Florida versus the income tax in other states. There's only 7 states that don't have an income tax. And even my own son, who lives in Tennessee, has got a little business, and they have an income tax on S corporations, income tax on LLCs. So it's not like Florida. We're blessed to have S corporations pass through without any income. All right, well, I thank all of you for being here, your participation, and try not to be too confused. If you've got questions, certainly feel free to get with us.